Hello friends, welcome to our channel Easy Shorts of Learning. This video is about process costing. In this video, we will discuss about what do you mean by normal loss and abnormal gain, and how the process accounts are prepared in process costing. So friends, if you have not yet subscribed my channel, please subscribe my channel, and if you have any query related to this topic, please write me in the comment box. Let's start with. First, we will discuss about what do you mean by abnormal loss and abnormal gain. Suppose in a factory or in process first, the gross input are 10,000 units and the normal loss, that is the loss which is expected in the production process, are 10% of gross input. So our normal loss units are 1000 units. Now, when we calculate normal output is that output which is obtained in the production process under normal circumstances. And the formula to calculate normal output is input minus normal loss. Here, input is 10,000 units and our normal loss units are 1000. So, normal output is 9,000 units. Now, if the actual output is less than normal output, suppose here the actual output is 8,600 units, it means in this process the extra loss occur which is 400 units, and this extra loss is known as abnormal loss, which is credited in the production process. Now in second case, if the gross input is again 10,000 units and normal loss is 10% of gross input, which is 1000 units. Now in this case the normal output is again 9000 units. So the formula to calculate normal output is input minus normal loss. Here input units are 10,000 and our normal loss is 1000. So our normal output here is 9000 units. And if the actual output is above the normal output, it means here if the actual output is 9200 units, it means in this process the firm will earn an extra gain or the extra profit of 200 units. This extra units are known as abnormal gain, and this abnormal gain is debited in the production or the process account. So abnormal gain occurs where the actual output is less than normal output, and abnormal gain occurs when the actual output is more than normal output. So friends, now we discuss about how the process accounts are prepared. In this question, a product passes through three processes before completion. Number one process is process A. The output of process A becomes the input of process B. The output of process B becomes the input of process C, and the output of process C are sold out in the market because they are the finished goods. So in process A, our gross input are 20,000 units costing rupees 1 lakh. The additional expenses in process A, material 40,000. In process B, the secondary material is 60,000 rupees, and in process C, the secondary material is 50,000 rupees. The labor cost incurred in process A, B and C are 22,000, 32,800 and 9,200 respectively. The work expenses incurred in process A, process B and process C are 10,000 rupees, 8,000 rupees and 6,000 rupees. Now the next one is normal loss on input. This normal loss is 5% on input in process A, which is sold out in the market at the price of rupees 1 per unit. In process B, the normal loss is 10% of input, which is sold out in the market at the price of rupees 2 per unit. And in process C, the normal loss is 5% of input, which is sold out in the market at the price of 2.5 per unit. The actual output which is given in process A, that becomes the input of next process. So the output of process A are 18,000 units, that becomes the input of process B. the output of process B are 16,000 units, that becomes the input of process C, and the output of process C are 15,400 units. They are the finished goods and are sold out in the market. So first we prepared the process A account. The format to prepare process A account comprises of, on debit side, three columns we have to make. Number one is particulars, second one units, and third one rupees. And in credit side, again these three columns, particulars, units, and rupees are there. Now first we have to debit all the expenses related to this process account. So first entry is to input, that is the gross input or the primary material input in this process. So in units we have to write 20,000, and these 20,000 units of raw material costing rupees 1 lakh. Next expense is material or the secondary material costing rupees 40,000. Wages paid to the labor or the labor cost here is 22,000, and the work expenses incurred in this process is 10,000 rupees. So these are the expenses that are debited in the process account. Now first we have to consider the normal loss. The normal loss is 5% of input. So we credit the normal loss. So our entry is by normal loss. Normal loss units are, the input are 20,000 units and normal loss is 5% of input. So here the normal loss units are 1,000, that are sold out in the market at the price of 1 rupees per unit. So our net realizable value from the normal loss is 1,000 rupees. Now we consider three steps to calculate if there is any abnormal loss or abnormal gain in any process account, or what is the cost per unit in this process account. So our step number first, in this step we have to calculate normal output, and the formula to calculate normal output is input minus normal loss. Here input are 20,000 units and normal loss units are 1,000. So our normal output here is 19,000 units. In second step, we have to compare normal output and actual output. Here the normal output which we have calculated in step number 1 are 19,000 units, and the actual output that is given in question are 18,000 units, which is less than the normal output. So here again we assume that our output is 19,000 units, but our actual output is less than normal output, which is 18,000 units. So the abnormal loss will occur in this process, and the abnormal loss units are 1,000. So we credit this 1,000 by abnormal loss 1,000 units. Now in amount column we have to calculate, first we have to calculate cost per unit. For this, our step number 3, the formula to calculate cost per unit is total cost minus net realizable value divided by normal output. Here the total cost is the debit side total, and the debit side total is which comprises of input, secondary material, labor, and work expenses. So our total cost of this process is 1,72,000, and the net realizable value is the sale value of normal loss, which is 1,000 rupees. So we have to deduct sale value of normal loss or the net realizable value, which is 1,000 rupees, divided by normal output, that is 19,000 units. So our cost per unit here is 9 rupees per unit. So for the valuation of abnormal loss, first we have to take units, and that units are multiplied with 9 rupees per unit. So our abnormal loss in rupees is 9,000. Now the balancing value of process A becomes the input of process B, and the entry we done here by process B account. This is our balancing value which is transferred to next process. So first we have to total the debit side. In units column we have to write 20,000, and in amount column we have to write 1,72,000. Now again we write these amounts on credit side to find out the balancing value, and the balancing value here is 18,000 is our output of this process, costing rupees 1,62,000. Now this becomes the input of next process. So this by process B account is transferred to B account on debit side. So in next process account we have to input the material which is the output of previous process. So we write to process A account, number of units that are transferred are 18,000, costing 1,62,000. Now additional expenses of this process comprises of number 1, to material costing rupees 60,000, to labor costing rupees 32,800, and work expenses incurred in this process costing rupees 8,000. So these are our total costs which are debited in the process account. Now first we have to write on credit side by normal loss, and the normal loss units are 10% of input. So our input here is 18,000 units, and the 10% of this is normal loss. So our normal loss units are 1800, which are sold out in the market at a price of rupees 2 per unit. So our net realizable value or the sale value of normal loss is 3,600. Now again we have to follow 3 steps to calculate normal loss or abnormal gain or abnormal loss or the cost per unit. So our step number 1, we have to calculate normal output, and the formula to calculate normal output is input minus normal loss. Here our input is 18,000 units, our normal loss units are 1800, so our normal output here is 16,200 units. In next step we have to compare this normal output with actual output. So our normal output are 16,200 units, which is the output under normal circumstances, but our actual output here is 16,000 units which are given in question. So here again our actual output is less than normal output, so the abnormal loss units here are 200 units. So we credited these abnormal loss units by abnormal loss. In units we have to write 200. Now in step number 3rd we have to calculate cost per unit, and the formula to calculate cost per unit are total cost minus net realizable value divided by normal output. The total cost is the debit side total. So here the total cost is 2,62,800, and net realizable value is the sale value of normal loss, which is 3,600. So we deduct 3,600 from our total cost divided by normal output. Here the normal output is 16,200 units. So the cost per unit here is 16 rupees per unit. Now we value our abnormal loss by multiplying 200 units with cost per unit, which is 16 rupees per unit. So here in amount column we have to write 3,200. Now the balancing value of process B is transferred to process C account. So first we have to total the debit side, which is in units column we have to write 18,000, and in amount column we have to write 2,62,000, 800. Again we have to write these two values in credit side, 18,000 in units and 2,62,800 in amount column. The balancing value is transferred to process C account. So by process C account, the units are 16,000, which is the actual output of process B account. That becomes the input of process C, costing rupees 2,56,000. This is our balancing value. Now in process C, first we have to input our units that are transferred from process B account. So to process B, number of units are 16,000, costing rupees 2,56,000. The additional expenses here is material costing rupees 50,000, labor cost or the wages paid to the labor costing rupees 9,200, and the work expenses incurred in this process is 6,000 rupees. Now on credit side, first we have to write our normal loss. In this process, the normal loss units are 5% on input. Here our input is 16,000 units and normal loss is 5% of 16,000. So our normal loss units are 800 and our net realizable value or the sale value of normal loss is 2.5 per unit. So when we multiply 2.5 with 800, our value that comes or the net realizable value is 2,000 rupees. Now when we follow these three steps to calculate cost per unit, our step number first, where we have to calculate normal output, and the formula that we use is input minus normal loss. Here the input units are 16,000 and normal loss units are 800. So our normal output here is 15,200 units. Now in second step, we have to compare normal output with actual output. Here the normal output are 15,200 units and the actual output which is given in question are 15,400 units, which is more than normal output. It means it reduces our normal loss, and we assume that our normal output or the output of this process is 15,200 units, but the actual output which is more than normal output are 15,400 units. So in this case we earned or the abnormal gain units are 200 units, which is debited in the process account. So on debit side we have to write 2 abnormal gain and our units are 200. Now for the valuation of abnormal gain we have to calculate cost per unit. So our step number 3 is cost per unit, and the formula to calculate cost per unit is total cost minus net realizable value divided by normal output. Here the total cost is 3,21,200 and the net realizable value or the sale value of normal loss is 2,000 rupees, which is deducted from the total cost, and our normal output are 15,200 units. So here our cost per unit is 21 rupees per unit, which is multiplied with abnormal gain units. So our abnormal gain in rupees is 4,200. Now the output of process C becomes the finished goods. So here the balancing value becomes the by finish goods account. So first we have to total the debit side, which is 16,200 units, and in amount column we have to write 3,25,400. Again we have to write these values on credit side to find out the balancing value, and in amount column we have to write 3,25,400. So our balancing value here is in units. Our finished goods are 15,400 costing rupees 3,23,400. Now this is our finished goods which are sold out in the market. So friends, in this video, first we discuss about what do you mean by normal loss, and abnormal gain. Then we have to prepare process accounts to find out the valuation of abnormal gain or abnormal loss. So friends, if you like this video, please share this video and subscribe this channel. Thank you so much. Have a nice day.